Well, if you look at the forward curves, they're looking at your 1 year and your 2 year, then they're saying it's going to be higher. So
4% cash?
Yeah. But again, if we take a step back and think about this, is this really an inflationary shock or is this a growth shock? And we're edging towards a more growth shock. So therefore, rates in 12 months' time should be lower than they are today. And that's why we've been loading up on the shorter end of especially the European market, where we look at our scenarios, the raising rates is pretty much priced in now. But again, they're going to be hit by the growth shock. And so gives them room to cut.
Where do you see the best value out there geographically? U.S., Europe, Asia, where do you see the best value?
In terms of bonds or
yes.
Because we do the multi-asset.
Yeah, well, I'm going to get to the multi-asset. We'll start with the bonds. We'll stick with the bonds.
So short end of the European curve, because that's the one that's got hit the most. And you see in the rallies, they don't come down as much as the Japan or the US markets.
All right, so in the US, in the equities, 2025 was a good year. Rest of the world, many markets were a lot better. Part of that was the weakening dollar, but part of it was kind of a rotation maybe out of some of the tech names. How do you think about the global equity opportunities these days? So
at the moment, our core scenario is for the rest of the world to outperform the US this year until we hit this. But we also wrote a piece on counter-trend rallies in the structural reduction in the dollar. So we believe the dollar is going to be lower over the next 3 to 5 years. But you get these counter-cyclical rallies, and therefore that's what we're in at the moment. So therefore you cut your views and cut your risk in order to reflect that, but then look for those opportunities. And we go to Japan, then the earnings haven't been affected.
Right.
It's purely the repositioning volatility that's caused the market to underperform.
So coming into the year, there was, I don't know if it was a consensus, but it was certainly a widely held view that the dollar still had farther to go down. Then a hot war breaks out in the Middle East, and we get the DXY back up to 100, where it's kind of been here. But you still believe the fundamentals are for a weaker dollar once the geopolitics settles down?
Yes, absolutely. You've seen the dollar. You've seen central banks try to move away from the dollar. That's why the rally in gold's been happening. But you've also seen that investors think the dollar's expensive, and you can look at PPP measures, et cetera, saying it's expensive. But for the rest of the world, emerging markets to outperform, you need that weaker dollar. So it's one of these things where you look at it and go, actually, you do see these risk-off moves, and you see the dollar rally, but you haven't seen it rally as much as in previous risk-off moves.
I agree. And we haven't seen the equity market tank like we've seen, right?
Correct. So we think the equity market's way too optimistic, but they're going to be supported by earnings, which won't include things.
What about guidance? You've been doing this. Did you see his resume?
First of all, I'm confused.
Is there a place you haven't worked in London?
I'm confused.
The entire city?
Yep. I mean, his bio says Perth, so I think Perth, Australia. But it's Perth in Scotland?
Correct. Unfortunately, I don't have an accent.
In Scotland?
That's the original Perth.
All right. I guess everything. And there's a Dundee right there as well. There's a Dundee in Scotland.
Oh, really?
Yes.
I'm learning so much here. All right. So just to go to Tom's question real quickly, what's the best value? Stocks, bonds? Where do you guys see it right now?
So if the Straits of Hormuz opens tomorrow or today, then we think stocks have the most upside.
Okay.
However, at the moment, you can't take that view.